Aloha, welcome back. One more lesson for Chapter 7. This time we have switched to exercise E7-20, which is again the same material, same information from the previous exercise that we worked on, E7-5. Except that we are switching now from the periodic inventory method to the perpetual inventory method. So one big difference with the perpetual, in the periodic method, we do our calculations for cost of goods sold and ending inventory at the end of the period. Now normally the end of the period would be the end of the fiscal year, but in exercise 7-5 we were doing it at the end of the month of January. Either way, we can apply those principles for the periodic inventory method. In exercise 7-20, we are using the perpetual method. And with the perpetual method, every time there is a sale transaction, we need to recalculate, or I should say we need to calculate our cost of goods sold. We do not wait until the end of that accounting period. We calculate it as we move through the period, as we move through the year, or in this case, as we move through the month. So in January here, we started out with our beginning inventory of 120 units at $8 each. And then on January 15th, we had our first purchase of 380 units, and unit cost had moved to $9 each. And then the exercise tells us that our sale of 240 units happened after January 15th. So it happened between January 16th and January 23rd. On January 24th, we had our last purchase for the month. So we need to focus on our sale of 240 units. And notice what I have put up here for you to see. Notice that our beginning inventory, our purchase, our two purchases, the 15th and the 24th, that information doesn't change for this exercise regardless of which cost flow assumption we are using. Also, the units sold, 240 units, that information does not change regardless of which cost flow assumption we are using. The only thing that will change based on the cost flow assumption in use is, number one, our calculation of the cost of this sale, and number two, the resulting ending inventory. Okay, again, using the perpetual inventory method, the only thing that will change for our period, and of course this is a very abbreviated example, we have beginning inventory, 2 purchases and only 1 sale. The only thing that will change is our cost of sale calculation, and based on this number, which is a subtraction of cost for inventory sold, that will affect the amount of our ending inventory. So let's work through each of these cost flow assumptions separately. In the first one, FIFO, first in, first out. At this point in time, we sold 240 units. And so first in, first out tells us we calculate the cost of this sale from the top, working our way down. So we start out with the 120 at $8, and then we need another 120 at $9. So our cost of goods sold is $2,040. When we hit the end of the month, we need to figure out the cost of our ending inventory, and that's going to be using first in, first out. Earliest inventory sold first, so our ending inventory is at the bottom, working its way up. So our ending inventory is made up of this 200 units at $11, and of this 380 unit purchase, we have 260 units left at $9 for a total of $4,540. Again, our check figure, our control point is goods available, 6,580. Now when we switch to LIFO, last in, first out, at the point of the sale of 240 units, what is our most recent cost? Well, our most recent cost is in the purchase prior to the sale. So using LIFO, the cost of this 240 units is at $9. So our cost of sales is $2,160. And notice again, as with the periodic method, when prices are rising and our unit cost rose from $8 to $9 in a period of rising prices or inflation, the LIFO cost flow assumption will yield a cost of sales that is higher than the equivalent calculation under FIFO. So that holds true regardless of whether we're using periodic or perpetual inventory method. I'm sorry, yeah, correct. Periodic versus perpetual inventory method. So we have our cost of sale calculation under LIFO. Then we also need to calculate our ending inventory. Now, we have sold 240 of these units. So what's left at the end of the month? Well, our last in, first out assumption says that our ending inventory is our earliest inventory working its way forward. So our ending inventory is comprised of the 120 at $8 each. Then of this 380, since we sold 240, we have 140 left at $9 each. And then finally our last purchase for the month, 200 units at $11 each. So when we do these calculations, we come up with ending inventory of 4,420. And again, our check amount is our goods available of 6,580. So we see our calculations for each of these two cost flow assumptions under the perpetual inventory method. Now, the exercise doesn't ask us to do weighted average. Weighted average in a perpetual system is a bit more complicated. And the reason is that when you use weighted average, every time, well, when you use your perpetual, let me start at the beginning. When you use the perpetual inventory method, you need to calculate the cost of each and every sale as you move forward in time. The cost of each and every sale needs to be calculated. When you're using the weighted average cost flow assumption with the perpetual inventory method, that means you must re-average your cost, your unit cost, every time you make a sale. So if you're a big business with a lot of sales, you can understand how much work that would be if you were doing it by hand. And so you almost have to have a very good computerized accounting system. Normally what's referred to as a point of sale system to do the math for you and to do the calculations. So But since we have only one sale here in this example, we were able to do it without too much work. The cost of this sale is going to be based on the average cost at that point in time. So to get the average cost at the point of this sale, we need to take our total cost, which is the total of these two amounts, and our total units, which is the total of these two amounts, and get our average. And so if we divide total dollars by total units, our average is $8.76. Keep in mind, we have inventory at 8 and we have inventory at 9, and more of our inventory is at 9, and so notice our average works out to be $8.76. And so if you have a knack with numbers, I think you would agree that that looks right. So we take our average unit cost and we multiply by the number of units sold to get our cost for that sale, which works out to be $2,102.40. We couldn't stop there, and we really need to do the rest of the calculations. We need to figure out our ending inventory, and our inventory would be based on an average after the last transaction for the month, or for the period, which in this case is a month, which is a purchase. And so at that point, again, we need to stop and re-average our unit cost. Our numbers are going to change. We will have our beginning inventory plus the purchase on January 15th, less the cost of the sale of 240 units. So when we take the total of this amount, and subtract this amount, and then add in our last purchase for the month of $2,200, our total cost at that point is $4,477.60. Now, that really is our ending inventory, but just to illustrate how the math would be done, we would take our total cost and divide it by our total units available at the end of the month, which is the ending inventory in units, 460. We get our average, our recalculated average cost, which is $9.70, roughly 73.5 cents, 9.7339. And then again we multiply it by the number of units in the ending inventory to come back to our ending inventory dollar amount of $4,477.60. So again, using weighted average with the perpetual inventory method, our focus really is on the calculation of the cost of each sale moving forward. Again, our check figure, the total of our cost of sale plus our ending inventory must always equal our goods available for sale. Finally, of note, something you might want to just keep in mind. When we use the periodic inventory method, under FIFO, notice our numbers were 2040 and 4540 for cost of sales and ending inventory, FIFO under the periodic method. When we use FIFO under the perpetual method, those two numbers are exactly the same, and that is so all the time. When we move to when we move to LIFO, last in first out, or weighted average, however, our numbers will change, depending on whether we're using the periodic inventory method or the perpetual inventory method. Now this is, again, it's a short example, It's a short example, but it's a lot of information. Most students take a while to digest it and understand it. So I think, you may find yourself reading through this material several times. Come back to this video if you find it helpful, and I hope you do. And hopefully you can get a pretty good grasp on this material. Thanks a lot, and our next lesson will be on Chapter 8.